The final witnesses for today's hearing are Neil Barofsky, the Special Inspector General for TARP, Thomas Baxter, the General Counsel, Executive Vice President of the Federal Reserve Bank of New York, Elias Habio, the former Chief Financial Officer of the Financial Services Group of AIG, and Stephen Friedman, the former Chairman of the Board of Directors of the Federal Reserve Bank of New York and current member of the Board of Directors of Goldman Sachs. May I ask the witnesses to stand while I administer the oath? Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? Let the record reflect that the witnesses have answered in the affirmative. You may now be seated. I'll ask the witnesses to summarize their testimony in 5 minutes. The yellow light means you have a minute left. The red light means stop. And then, of course, we will have time for questions from members whom I now. All the witnesses have opening statements, so I believe that given the 4 votes, the members will be back by the time your statements are done for questions. Thank you. Mr. Barofsky, would you present your testimony first?
Thank you, Madam Chair. It's an honor to once again to be back testifying before this committee. I'd like to thank this committee for the support it's shown our office, as well as its leadership and tenacity in bringing about transparency to the AIG bailout generally, and in particular to the counterparty payments. This past November, we issued our audit, an audit that was requested by Representative Cummings and 26 other members of Congress, including members of this committee, reporting on the decision-making process that led to then-President Geithner and the Federal Reserve making the decision, the choice, to pay 100 cents on the dollar, effectively par value, for a series of securities that at the time were worth less than half of that amount. And as we demonstrated in the audit, that was in fact a choice, a series of policy choices that were made that limited the ability of the Federal Reserve in its negotiations, and a choice to conduct the negotiations in the way that they did. And in our audit and in our testimony, we lay out the different justifications and explanations given by the Federal Reserve, many of which Secretary Geithner repeated this morning, and our responses and in some cases our criticisms of those policy decisions. What I'd like to focus on today, though, is expanding a different theme in the audit, and that's looking at the tone and amount of effort that went into those negotiations, even assuming all of those policy decisions which restricted the latitude of the Federal Reserve. How are those negotiations conducted? Well, essentially, a number of mid and senior level executives at the FRBNY reached out to their counterpart at AIG's counterparties. They did basically over the telephone, and after informing them that even the negotiations themselves were voluntary, they asked if they would be willing to take a haircut on the amount of concession. For 7 of the 8, the answer was no. For the 8th, UBS, the answer was yes, so long as the other counterparties also agreed to a similar concession. The Federal Reserve at that point decided to shut down negotiations, not to pursue that willingness to negotiate, and decided, with the approval of Secretary Geithner, to pay 100 cents on the dollar. Now, this stands in stark contrast to a negotiation that occurred just a few weeks earlier. And this, of course, was the negotiation by which the government purchased $125 billion of preferred securities from the 9 largest institutions as part of the TARP's capital purchase program. There, unlike in AIG, it were the principals that were involved. President Geithner, Secretary Paulson, and Chairman Bernanke on behalf of the government, and on behalf of the counterparties, the banks, some of the exact same banks that were subject to the AIG discussions, the chief executive officers. There, unlike in AIG, the conversations weren't conducted over the telephone. Each of those CEOs was summoned to Washington and told to appear in a Treasury conference room, gathered together. And there, unlike in AIG, the message was forceful. President Geithner, Chairman Bernanke, Secretary Paulson, and others made it very clear of the importance that they believed that this negotiation was, how important it was for the banks to agree. They used the terms like that it would be good for the country for them to do so. No such similar effort was taken with respect to the AIG negotiations. And the result, with the capital purchase program, 100% agreement. The result for the AIG, as we all know, were failed negotiations. Now, would it have made a difference if President Geithner or Secretary Paulson got on the phone and talked to those chief executive officers? Would it have resulted in the savings of billions or tens of billions of dollars for the taxpayer? We don't know. We can't know. But we do know, because we've recently been informed by the French regulator, the same regulator that the Federal Reserve cited their intransigence as being one of the great barriers to achieving effective negotiated haircuts. They recently told SIGTARP that, in fact, they would have been willing to engage in just such a negotiation, so long as it was at a very high level, so long as it was completely transparent, and as long as it was universal agreement. Everyone came around the table. And we also know that if such negotiations occurred and were successful, they would have addressed all of the concerns that Secretary Geithner addressed this morning and many of the concerns that were outlined in our audit of concerns by the Federal Reserve. But we'll never know, because that effort was simply not taken. Madam Chair, our audit covers, I see my time is running low. Our audit obviously covers a lot of other issues, as does our testimony, including some of the recent troubling comments from Treasury that impact transparency. And of course, I'll be available to answer any questions that you or other members of the committee may have. Thank you.
Thank you, Mr. Barofsky. Mr. Baxter, we'd like you to go next.
Good afternoon, Madam Chairman Norton, Ranking Member Issa, and other members of this committee. Thank you for inviting me to appear here today. As the General Counsel of the Federal Reserve Bank of New York, I welcome the opportunity to talk about the Federal Reserve's work to stabilize AIG at a critical point. I will also address the role played by the Federal Reserve Bank of New York in securities disclosures made by AIG. Let me begin with just a few words about autumn 2008, when our nation was challenged by a financial crisis of a kind we had not seen since the Great Depression. At the New York Fed, we were literally working around the clock trying to implement a number of liquidity programs directed toward market stability. Today, we consider some of the actions taken during those frenetic times with respect to AIG. Everything we have done since this crisis began has been with the goal of stabilizing our financial system and assisting our economic recovery. Turning to September 2008 and the actions taken by the New York Fed, the Board of Governors of the Federal Reserve System, and the Department of the Treasury, they were designed to avoid the catastrophic systemic consequences that would have resulted from an AIG bankruptcy. Every American would have been adversely impacted. We did not lend to AIG because we wanted to, but because we had to. A decision not to act might have been easier on us, but it would have been worse for all. Now I will turn to the specific issues that bring me here today. First, there have been concerns about AIG's counterparties receiving large payments for terminating CDS contracts and selling collateralized debt obligations. There have been allegations that this was a backdoor bailout designed by the Federal Reserve to assist the banks at the expense of the American taxpayer. These allegations are not true. AIG was scheduled to announce an earnings loss of nearly $25 billion on November 10, 2008. Had we not reached agreement with the counterparties to terminate their credit default swap contracts by that date, by acquiring the CDOs, AIG would have been downgraded by the credit rating agencies and thrown once again to the brink of bankruptcy. This would have returned us to the situation we faced in September and required even further government support. We took the action needed to terminate the CDS contracts by the deadline, and our focus was on solving the AIG liquidity problem, not on benefiting AIG's counterparties. Second, I would like to clarify the misunderstanding that the Federal Reserve and Treasury Department received nothing of value in exchange for the payments to AIG's counterparties. As part of the termination deal, the Federal Reserve, through its special purpose vehicle Maiden Lane 3, paid approximately $29 billion and received assets with a fair market value of $29 billion. The par value of the assets was approximately $62 billion. Today, the value of the assets, which secure the Federal Reserve's loan, exceeds our loan balance by several billion dollars. Third, concerns have been expressed about our involvement in AIG's securities disclosures. In particular, there have been allegations that we somehow tried to engage in a cover-up by recommending that AIG strike certain sentences in its SEC disclosures related to the payments to the counterparties. These allegations are not true. Our sole purpose was to ensure that securities law disclosures by AIG were accurate and appropriately protective of taxpayer interests. Let me finish by thanking the committee for holding this hearing. We submitted an extensive statement yesterday, and we have delivered 250,000 pages of documents to you. I believe that, upon careful examination, the committee will see that our actions successfully addressed a potentially calamitous risk to the economy, and in doing so, protected the interests of the American people.
Thank you, Mr. Baxter. Mr. Habio, we're ready for your testimony.
Madam Chairman, Ranking Member Issa, members of the committee, thank you for the invitation to appear before you today. From September 2005 until May of last year, I was Senior Vice President and Chief Financial Officer of the Financial Services Division at American International Group. I left AIG in May 2009 on excellent terms and continued to provide advisory services to the company while I planned the next phase of my career. By way of additional background, I'm a licensed CPA and practiced with Deloitte & Touche, becoming a partner in 2003. My position with AIG gave me some insights into Maiden Lane 3. Maiden Lane 3 LLC is a financing entity created by the Federal Reserve Bank of New York. The entity helped facilitate the unwinding of a significant portion of AIG Financial Products credit default swaps by purchasing the underlying multi-sector CDO bonds from FP swap counterparties. At the same time, the related swaps were terminated. I understand that the committee is interested in learning more about these transactions. These transactions were critical to AIG. They significantly reduced the risk of substantial collateral postings to counterparties that FP was required to make under the swaps. They also reduced the erosion to AIG's capital from mounting mark-to-market losses on the swaps. A little history is helpful. During the subprime mortgage crisis, the bonds underlying FP swaps began to decrease in value. As a result, beginning in late 2007 through 2008, FP reported billions of dollars of mark-to-market losses on the swaps under the fair value accounting rules. FP also posted billions of dollars in collateral to its swap counterparties as a result of the declining market value of the bonds and declines in AIG's and the reference bonds' credit ratings. AIG lacked the financial resources to come up with a large-scale solution. Because AIG is not a bank, it did not have access to funding through the Federal Reserve in the normal course. Instead, AIG had to rely on the capital markets. By the beginning of September 2008, the collateral postings and the mark-to-market losses, along with other factors, were straining AIG's liquidity. But AIG was not able to access the capital markets. On September 15, 2008, the rating agencies downgraded AIG, triggering an onslaught of new collateral calls. Even after the federal rescue on September 16, 2008, AIG still needed to reduce its exposure to the mark-to-market losses and collateral calls on FP swaps. The federal rescue did not stop these losses or payment obligations. This is what led to the creation of Maiden Lane 3. Under the terms negotiated by the New York Fed with the swap counterparties, Maiden Lane 3 bought the underlying bonds at the then market value. Specifically, Maiden Lane 3 purchased approximately $62 billion in notional amount of bonds underlying notional par value and its not market value. The collateral that FP had posted to date was used to pay the cost of terminating the swaps, specifically the counterparties, approximately $62 billion. To conclude, Maiden Lane 3 was critical in mitigating AIG's continued exposure to the significant mark-to-market losses and collateral calls on the swaps that was draining AIG's capital and liquidity. I'm happy to answer any questions the members of the committee may have. Thank you.
Thank you very much, Mr. Habio. Mr. Friedman.
As indicated in my prepared statement, I have little factual information to offer in response to the questions set forth in the committee's invitation for me to testify. The explanation for my lack of involvement in the New York Reserve Bank AIG counterparty transactions requires an appreciation of the limited role that a Reserve Bank's chairman and board of directors play in a Reserve Bank's operation. A Reserve Bank's board of directors is really more akin to an advisory board. It is actually sort of a hybrid, more akin to that than it is to the board of directors of a typical corporation. Reserve Bank directors serve part-time, make observations on the economy and markets, make recommendations on monetary policy, and approve the bank's budget, internal controls and policies and procedures and personnel matters. But consistent with the structure created by the Federal Reserve Act, the directors of the 12 Federal Reserve Banks have no role in the regulation, supervision, or oversight of banks, bank holding companies, or other financial institutions. Such responsibilities, including the extraordinary financial interventions of 2008, are instead carried out by the officers of the 12 regional Federal Reserve Banks, acting at the direction and with the oversight of the Board of Governors of the Federal Reserve System in Washington. In other words, the Board of Governors in Washington effectively is the Board of Directors for Reserve Bank undertakings such as the AIG financial rescue transactions. Accordingly, as I explained to committee staff and consistent with the Fed's ground rules, whether as chairman of the New York Federal Reserve Board or otherwise, I was not involved in the decision to bail out AIG, the decision to repay the AIG counterparties at par, or the decision not to publicly disclose those counterparties' names. I did not ratify those decisions, and I do not know just who made those decisions. I am advised that on the evening of November 9th, 2008, the chair of the bank's audit committee and I received a telephonic summary briefing from bank officials about the transaction. At that point, the deal had been signed up and was to be announced by the Board of Governors the next morning. Finally, I would note that by statutory design, the boards of the reserve banks are comprised of members with intentionally diverse financial interests and affiliations, such that the directors' recommendations and advice on monetary policy include input from a diverse array of bankers, borrowers, and community leaders. Because the boards, once again by statutory design, include bank executives and bank shareholders, many current directors would have conflicts of interest if the Reserve Bank boards of directors also had any authority over or any role in individual supervisory matters. matters like the New York Reserve Bank's rescue of AIG and the AIG Counterparty transactions. But the New York Reserve Board does not have such authority, and it and I were walled off from these matters, really ring-fenced. I stand ready to answer any questions the committee may have.
Mr. Friedman, let's begin with Mr. Baxter. Mr. Baxter, the committee notes that you have said publicly on a number of occasions that AIG and not the Federal Reserve of New York had the final say on disclosures. The committee has, however, in its possession an email, I believe it is up there, it was obtained by subpoena. It involves a senior person in your office, and the words said are, any public disclosure by AIG was still subject to FRS approval, Federal Reserve Service approval. Doesn't sound like, sounds pretty much like the Federal Reserve has the final approval with that kind of statement. If what you say about AIG having the final decision is true, why did a top New York Fed employee say that the final approval, in effect, rests with the Federal Reserve?
Madam Chairman, as I look at that email, I don't see it being addressed to me, so I will have to speculate as to why the author of that email included.
Who do you think it was addressed to, Mr. Baxter?
Well,
you don't just send emails in the air.
I can't read it well enough, Madam Chair, to tell you, but it doesn't look like it's addressed to me. Madam Chair, I'm willing to speculate.
Well, since you raised the issue of who, it is from Stephen Mazzari to Sarah Dahlgren. It is your top people, your proxies speak for you, do they not?
They are not only very senior people, they are also very diligent people. And with respect to the email, Madam Chair, it doesn't refer to securities disclosure. It refers to a public disclosure by AIG, so I'd point that out as one item. With respect to AIG's securities disclosures, those are AIG's legal obligations under our securities laws, given that AIG was then and is now a publicly traded company. So in the first instance, AIG has a responsibility to comply with our securities laws, and that's the starting point. Now, it is true that AIG shared its securities law disclosures with the Fed. And it is true that the Fed commented on those draft securities law disclosures of AIG. Our purpose in making those comments was twofold. First, to assure accuracy, and second, to protect the taxpayer interest. But at no point, Madam Chair, did we ever interfere with a mandatory obligation of AIG to report to the SEC in a securities filing. It was always for the two interests that I mentioned, the interest of accuracy and the interest of protecting the taxpayer interest, that we commented on AIG's public disclosures. Now it could not
The word approval is a very troubling word here, because it implies what it says.
It is, Madam Chair, and it could not be for an AIG public filing an approval, because that legal obligation with respect to AIG's securities filings as a public company is AIG's. It cannot be delegated to someone else.
Yeah, agreed.
Not even someone at the Federal
Agreed, but
Reserve.
it looks as though a very powerful agency was saying otherwise. I agree with what you say, but that's not what the email said. And you can, perhaps you can see why it makes it look as though the Federal Reserve of New York is not being upfront with, was not being upfront with the American people. Here behind the scenes were these emails that put the Federal Reserve in a position that you yourself indicate is not a position it can have under law.
Correct.
Mr. Barofsky, perhaps you can help me. I'm sitting here listening to this testimony, and I still cannot understand. I need to understand for a moment, putting yourself in the position of the parties, why you think AIG's counterparts were paid 100 cents on the dollar.
Well, I think that it's hard to put myself into the shoes of either the counterparties or the Federal Reserve, but my understanding of the discussions, I certainly understand why the counterparties wanted to be paid 100 cents on the dollar.
Of course, but that's not, why would the government want to do that? I mean, you cannot assume in a situation like this that somebody wants to do evil or wants to cheat the taxpayers. We're trying to get beneath the appearance, trying to place ourselves at the table with the parties, including the government, including the Federal Reserve, including AIG. So you yourself, in your testimony, lay out what had just occurred. Why would that procedure not be used?
I cannot give you an answer to that question. I think that if that effort and that tone were there, Mr. Baxter could answer that question. Probably Secretary Geithner could best answer that question.
But put your, I mean, again, if you have to assume that the best and not the worst, then what would be the best reason for not using the government's bargaining power?
I really cannot imagine. I think that, again, if accepting the policy limitations that they imposed upon themselves, and we don't accept them necessarily in the audit, but even accepting them, it seems to me that taking the effort, apparently, Secretary Geithner at the time was frequently speaking to the CEOs of many of these counterparties. It seems that just putting a little extra effort in trying to communicate the importance of this. I mean, negotiations were ongoing. It's not as if, some may think that they've made no effort in negotiations. There was some effort in negotiations.
So there was effort. So, when you say that they said, would you accept 100 cents on the dollar, less than 100 cents on the dollar, well, anybody would answer no to that question.
I mean, the surprising thing is that one of them did answer yes, and that wasn't pursued.
And why do you think he answered yes and the others answered no?
I think they were willing to negotiate, because I think that, if you look at it from...
Did he know the others had answered no?
Well, he said yes only as long as all the others would say yes. So his idea was that we would do that. UBS.
Well, why didn't he stick with the others? I mean, there must have been some, Mr. Baxter. Well, why would, if you see that there's solidarity here and maybe you can get the government where you want it, why would one person say yes? He must have known something. He must have feel something for the country. Did he feel something for the economy that made him do it? Is he a patriot and the others not?
I mean, I think that there was, this was UBS, and I think there probably was a recognition that the Federal Reserve had done so much for the global economy. And the American taxpayer, putting the American taxpayer had literally taken the entire global economy on its back and was supporting not just the U.S. institutions, but the global systemic risk that the sacrifices the taxpayer had made. And that, I think, is a powerful argument in the context of negotiations if it's made clear how important it was to the American decision makers, to the principals. And I think that perhaps, I don't want to crawl into the mind of the UBS, but there was a willingness to engage in these discussions, but as long as all the others. And because 7 of the 8 had said no, the Federal Reserve essentially shut down those negotiations. But I think it is a very fair question to say, why not do something similar to what was done just a couple weeks before in Washington with respect to the capital purchase program, which is, again, those were not a compelled transaction. It was ultimately a voluntary transaction, but the negotiations, if you will, were conducted in a very, very forceful manner that made it very clear that this was an issue of national importance.
So I would ask you the same question, Mr. Baxter. One of the reasons why people are so angry at the banks and at the government is that this is a common sense question that anybody would ask without being very learned or very practiced in negotiation. So could you give us your answer?
And I think, Madam Chair, this is a key question. The key question is, why didn't the Federal Reserve act successfully to get a concession of perhaps...
Is your mic on, sir?
I think it is. Why weren't we successful in getting a concession from the counterparties? Why wasn't AIG successful in getting a concession from the counterparties? Because that was the situation. And it is related to bargaining power. Now, typically, when a debtor is trying to restructure a debt with a creditor, the bargaining power that the debtor gets, Madam Chair, is from the threat of bankruptcy. This negotiation with the counterparties was taking place in the first week of November 2008. So how would the threat of bankruptcy have played during that particular period of time? And of course, Madam Chair, you know that the Federal Reserve had already interceded to save AIG from bankruptcy on September 16th of 2008, only 6 weeks before. So what about the bankruptcy threat? And I have three responses. First, that threat was not credible, given the actions of September 2008. Second, that threat of bankruptcy was not true. We weren't prepared to put AIG into bankruptcy in November of 2008. And we don't misrepresent situations in negotiations at the Federal Reserve.
But the threat was there. Excuse me, the difficulty and the bargaining positions were there. So I still don't understand why ask a simple question, then proceed with business as usual as if you weren't holding that threat card.
And I'm trying to explain exactly why we had no bargaining power with respect to the bankruptcy risk. The first is it wasn't credible. The second is it wasn't true, and it would have been unethical for us to suggest otherwise. And the third is it would have been counterproductive, because the biggest threat we were facing at that point was the threat of the credit rating agencies downgrading
Mr. Baxter,
AIG.
I understand that nuclear bomb threats are not credible. And I can understand your argument as to the insolvency. Mr. Barofsky, now, it's true that when you come in and you tell somebody, you're going to kill them, and you know for sure that you're not, and they know for sure you're not, then the question becomes, what is the next step after the nuclear bomb threat?
Sure. I think there's two things. First of all, what I was suggesting, that the principals got involved in negotiation, I wasn't suggesting that they threatened bankruptcy. My comparison to what happened a couple weeks earlier was presuming all of the restrictions that Mr. Baxter and Secretary Geithner had put on themselves, including not wanting to threaten bankruptcy. So first of all, I think that when drawing this comparison, I wasn't suggesting that they do. As to the complete absence of leverage, again, I think you have to look at this in the context of what the situation was, what the position of U.S. government officials explaining how important this was, much like they had 2 weeks earlier. And I don't think that they needed to threaten bankruptcy. However, as Secretary Geithner noted this morning, there was a very serious concern at the Federal Reserve and in the markets that there was going to be a downgrade of AIG, a downgrade that Secretary Geithner and the Federal Reserve have indicated to us would have resulted in AIG going into bankruptcy despite the best efforts of the Federal Reserve. There was a limit on how much money perhaps the Federal Reserve was willing to print at some point if bankruptcy was triggered. And I think that, again, without threatening bankruptcy, I think that if there was a negotiation, if everyone was in the room, the Federal Reserve could point to the fact that there was a possibility of a downgrade. They could point to what the market was treating AIG's debt at the time. The credit default swaps were through the roof. There was fear in the market that AIG would default. And again, without threatening the bankruptcy, could point out the fact that if there was not a resolution, if they didn't agree to a haircut, it may be difficult for the Federal Reserve to get board approval, for example, to pay 100 cents on the dollar. They had not yet received that approval. What I'm saying is that there is a whole different range of options in that negotiation that could have occurred had they simply brought everyone in the same room and if it was made a priority, if there was a level of effort across the board. I can't tell you if it would have worked. I have no idea if it would have worked.
Well, have you ever heard 100 cents on the dollar being given in, we've had no situation like this, but isn't that even rare as a way to come forward when you see a desperate situation on the other side? surely some gradations down from that were in order. And I guess I should ask Mr. Baxter, the puzzling thing is to come up with 100 cents on the dollar without proceeding through some other process until you maybe had to get there. And we don't see, the committee does not see how you, and is bothered by the spontaneous nature of the acceptance of the notion that the government had to pay 100 cents on the dollar. We've hardly heard of a negotiation in our lifetime where that's what two unequal parties at the table end up doing. No concession, 100 cents on the dollar. So perhaps you can tell us why what Mr. Barofsky says, at least some sense, yes, of course, you're not going to put them into bankruptcy. We do not question nearly as much the bottom line here as we question how you got to that bottom line.
Well, because we couldn't use the threat of bankruptcy, Madam Chair, one question was, could we use our regulatory or supervisory power? And we considered the answer to that question no, because that would have been an abuse of our power. And the reason we felt that is that it wasn't using the supervisory power with respect to an institution to get it to do something to enhance its safety and soundness. For example, like raise more capital. If an institution doesn't do that, then it's appropriate, if the Fed believes there is insufficient capital, to use a promise or a threat, perhaps of enforcement action, to induce the institution to take that action. That was not the case here. Here, the suggestion is we use our regulatory power to cause a counterparty to give up property in the form of a concession. So it's not using the regulatory power for the purpose intended by law. It's using the regulatory power as a promise or a threat to extract money from someone. And that raises all kinds of considerations that are not consistent with the rule of law. And if,
So
another point,
you
Madam Chair.
apparently didn't think you had to change the regulatory power in order to deal with Bank of America. Somehow you'd have to go back, change the law in order to deal with AIG.
Well, Madam Chair, remember what happened when we asked the two French banks, SocGen and Callion, if they would give a concession. Their first answer was no, and then they were supported in that negative answer by the French Banking Commission. So that happened with the two French banks. You also asked earlier about UBS. Now, UBS said we might consider as much as a 2% concession, but only if everyone does it, everyone else does that as well. And so there was a fairly effective blocking action there by UBS. Now, on the point about participating in the benefits of all of the Federal Reserve's and the Treasury's action in combating the financial crisis, with respect to UBS, Madam Chair, remember UBS had already been rescued by Switzerland in the financial crisis. So again, in UBS, we're dealing with UBS. We asked them if they would consider a concession. You know what their answer is, but it's a hard case to make that they owe the United States a favor when Switzerland had already come to their rescue.
Thank you, Mr. Baxter. I'm going to move now, since I've had more than a lot of time because it took you all so long to get back. I'm going to move to the ranking member.
I thank the chairwoman, and I certainly think that this was a good case for your not necessarily wanting a floor vote today, but any other day.
But not tomorrow, sir.
But not tomorrow. Thank you, Madam Chair. Mr. Baxter, I didn't know who you were after 30 years of loyal service until a few days ago. So forgive me for maybe not playing total catch-up. Your old boss, now Secretary Geithner, spoke glowingly about the staff and the hard work and the people involved. But we now believe and understand that a staff report was done within the Fed that said, let AIG go bankrupt, and that was never, ever brought before the board, that in fact Chairman Bernanke pulled it so it not be considered by the broader Board of Governors. Are you familiar with that study or report?
I am not.
You are not. So he kept it from a person who was at the, I mean, these emails show you were at the center of all of this. He kept from you his own staff's decision. Chairman Bernanke did not trust his own governors or even the New York Fed's inner circle with a recommendation that said let him go bankrupt. Does that surprise you?
First, Ranking Member, I'm the General Counsel of the New York Fed. The Chairman.
But all that
Board of
question
Governors?
was in the New York Fed. It was a study on behalf of the New York Fed. And,
Well, I don't know the study, and I'm sorry I don't.
okay. Well, with any luck and with the indulgence of the chair, we will get discovery on that. As of right now, all I have is a whistleblower and one senator who confirmed that it exists but has said on CNBC that he can't release it even though he thinks it's damning. Additionally, you're familiar with the Schedule A of the documents. Okay, so this unredacted form shows 57773 and some alpha numeric after that, and then shows that Deutsche Bank would be the counterparty recipient, the breakdown. Basically, these are sort of who owns the bonds, to put it in terms the American people don't understand. Are you familiar with this document called Schedule A? It was delivered from the Fed.
This is Schedule A to the shortfall agreement?
Yes.
Yes, I'm familiar with that.
Are you familiar with the cover-up that said that AIG, with the insistence of the Fed, clearly perpetrated by getting this made confidential and not disclosed to the public until 2018, that work continuing until May of this year, or last year?
Congressman, there was no cover-up. I can explain the processing of the Schedule A
Well,
to
if
the
you can just
shortfall
briefly
agreement.
tell me the first part, which is, are you familiar with the work that went on to seal this from being disclosed in public SEC filings at least until 2018?
I am familiar.
Okay, and in a short way, do you think that is right or wrong?
I think all of the conduct was perfectly appropriate.
Okay. Well, I'm going to leave that because, although I don't agree, ultimately I just wanted that answer, and we'll see in time on other people. Can you put up slide 23, please? Can you please explain what happened following your receipt of an email from Marshall Hubner? And did AIG ever make this filing with the SEC?
Would you like me to explain this?
Please, as briefly as possible.
This concerned a salary increase for the Chief Financial Officer of AIG, and Mr. Hubner was concerned about that salary increase. I was also concerned about that salary increase, and as a result of our collective concern, I had conversations with AIG, and the Chief Financial Officer in question decided that he really did not want the salary increase at this time. The salary increase was withdrawn.
Okay, so by talking him out of it, it didn't have to show up in a public filing, so it no harm, no foul in this case.
It had nothing to do with the public filing. It had everything to do with we didn't think this was appropriate,
Okay.
this salary increase.
Last question for you, and I want to quickly go to the SIGTARP. Do you know of a compelling legal authority that would have prevented AIG from going bankrupt? In other words, did the Fed have the authority to let them go bankrupt? Because Secretary Geithner has implied that he didn't have any options and he didn't have the authority to do anything but what he did. That's a pretty much yes or no. Did you or anyone at the New York Fed, to your knowledge, in fact, do a study or come up with a legal opinion that said you can't do anything else except let them go bankrupt, or do this and you can't let them go bankrupt?
First, we were not the supervisor of AIG on September 16th of 2008, so we had no supervisory responsibility.
But my question is, since
second,
Secretary Geithner was there and said there was no other choice, your boss made the call. Do you know of a legal opinion that he was given or that exists today as to that?
Well, I was his chief legal officer, and I would say then what I say now, and that is we need a resolution statute in this country to deal with institutions as systemically significant as AIG. We didn't have that tool in September of 2008, and we still don't have that tool, Congressman.
Okay.
We really need it.
But, you know, I'm going to ask just for 2 more minutes quickly to sort of counter the very long time, but I'll be very brief. I thank the chairman.
Yield the gentleman 2 minutes.
Mr. Barofsky, your report directly contradicts so much of what we're hearing from people that were there or are there as to whether we'll get paid back. Let me just break it down to just 2 questions and then take the rest of the 2 minutes for your answer. One, is it true that we're just not going to get paid back by anyone's reasonable estimation certain funds? And 2, had we used other means to underwrite AIG, such as we'll buy assets at a discount or we won't buy them, we will guarantee or give or buy at a discount, you decide whether you want our AAA rating versus actually getting the transfer at a time when these banks wanted to transfer. If any of these other techniques that you are now aware of that logically could have been used, would we be in as bad a situation of not getting paid back as we are? And then please elaborate on what we're seeing of what we're not going to get paid back that flies, and that doesn't even include, by the way, the idea that the money's come back and it's being respent in other ways. But just as to your knitting, can you give us as much knowledge, as much time as you have to answer that?
Sure. Ranking Member Issa, first of all, I just want to take the chance, as I said in my initial testimony, to thank you and the Chairman for your support of our organization and for the leadership and the tenacity that the 2 of you and this committee has shown in bringing transparency to the AIG bailout. The Treasury's own calculations is when they did their financial statement at the year-end September 30th, 2009, projected a more than $30 billion loss on its AIG investment. When you're looking at these counterparty payments, you can't look at just one part of them. They were basically in 2 chunks, if you will. There's the Federal Reserve loan to Maiden Lane 3, which purchased the securities. It was about $29 billion. And the rest were counterparty payments, the balance of about $33 billion, that AIG had previously made. So a total of about $62 billion. Now, with the chunk that the Federal Reserve lent to Maiden Lane 3, that portion, which we've been hearing about how that is on track to be paid back, and the taxpayer may the Federal Reserve Bank of New York may actually make a profit on that, I see no reason to think that that's not true. That may very well be accurate, that one piece of it. However, the other piece, and these really are 2 sides of the same coin, and we've been critical of trying to separate that out and only looking at the Federal Reserve piece and saying, oh, because that's going to get paid back, it's a profit. That other part is part of the projected $30 billion loss. So one of the reasons why we're so critical is that if you just say, oh, on these transactions where the federal government, the taxpayer, is on track to be made whole, for someone who's not as familiar with the intricacies of these transactions as we all are, you would get the misimpression that the counterparty payments, the decision to pay 100 cents on the dollar, is going to leave the taxpayer whole. And by Treasury's own calculations, you can't separate that $30 billion of anticipated loss from these transactions, because the money that AIG paid came from a loan from the Federal Reserve, a separate loan, that was then paid down with taxpayer money through the TARP. So I think it's very difficult, and I think it's inappropriate to separate those 2 out.
Thank you, Mr. Chairman.
And now yield 5 minutes to the gentleman from Massachusetts.
Thank you, Mr. Chairman. I want to thank the witnesses for your willingness to help the committee with its work. Mr. Barofsky, we've been going back and forth with Secretary Geithner and Secretary Paulson earlier today about the decision to pay the derivatives, credit default swaps that were entered into between AIG and Goldman Sachs and a handful of other companies. The position of the Secretary Geithner is that he didn't have any other tools other than paying 100% of the value, 100 cents on a dollar, or allowing AIG to go into default and bankruptcy. And at least the testimony of Mr. Paulson is that he was not there. And I find that mystifying. But whether, in your own impression and reviewing the record here, was there any opportunity for Secretary Geithner, the Treasury, the Fed, to negotiate a haircut with Goldman Sachs instead of paying them at par value? and thereby saving the American taxpayer possibly billions of dollars.
Yes, and I think that, as the Federal Reserve and the Secretary acknowledged, the whole plan, the hope from the Federal Reserve was to attempt a